All right. We'll go ahead and get started. So, welcome everyone to webinar two of our new series titled Ask Me Anything. We'll be hosting these every third Thursday at 3 p.m. In today's series, we welcome our HRlogics unemployment cost management subject matter experts into the room where there's no scripts, no presentations, just honest conversations. So, for those who are new or unfamiliar with HRlogics, let me take a minute to introduce you. At HRlogics, we simplify the time-sensitive tasks that it takes to tasks that drain HR and payroll teams, like managing unemployment claims, completing I-9s, handling employment and wage verifications, and securing tax credits. We bring the tools, expertise, and strategic insight to save companies time, reduce risk, and uncover real savings, often in places they didn't even know to look. With our powerful tech and industry-leading experts, we don't just manage compliance, we monetize it. So let's take a minute to go through a few housekeeping rules. So you guys are all muted. However, if you look at your Zoom bar, you should have a Q&A button. I'm going to let our brilliant leaders introduce themselves in a minute and kick off a couple of questions that we received in advance. But don't wait to put your questions in the chat. There we go. Don't wait to put your questions in the chat. The sooner you input them, the better chances they will be answered on the call today. So all webinars are hosted in HRlogics News and Resources section on our website. You can scan the QR code on the current slide and it will take you directly there. Additionally, you'll find educational blogs on hrlogics.com/blog. I love a good QR code for minimal typing, so you can scan the QR code on the right to bring you directly into all recent articles posted. Make sure you follow HRlogics on LinkedIn so you'll be in the know as soon as a new article is posted or about future events just like this one. So without further ado, I'll start the introductions. I am Elizabeth, also known as Biz. I'm the CRO of HRlogics and your host of the series. I have about 15 years experience in the applicant tracking and onboarding space, but love dreaming up new ideas to help our clients utilize our systems more efficiently. Often starting with our own internal use cases. So because of that, I helped found Rise Credits that was acquired by HRlogics in June of 2025. So if you'd like to connect, please scan the QR code on your screen and save my contact information as well as connect on LinkedIn. So now we have Joe Turner. Joe, tell us about your
All right.
history, why you're passionate about unemployment, and what we should know about you.
All right. Good afternoon, everybody. I'm Joe Turner. I'm the VP of Ops here with uh, HRlogics in the UCM field. I've been in the unemployment industry for 27 years. I've worked at three TPAs. This is my third. He'll introduce himself here in a moment, but I've worked with Josh Kendall going back uh, 20 some odd years, 20 more than I can imagine at this point. But my experience is really in the claims and hearing space, working on that side of coordinating with clients through difficult cases, making sure that we got the best unemployment claim responses, that we are getting them prepared for unemployment hearings on how to be successful in those, talking through, changes they may want to make in their policies or their documentation, just so that we have, again, the best information to make sure that we can avoid any unnecessarily paid out unemployment claims and charges against your unemployment accounts. So that's me. I guess I'll go ahead and pitch it to Josh.
Yeah, Josh Kendall, the man, the myth, the legend, give us a few words about why our listeners should be paying attention to unemployment and you on this call.
Oh, well, I hate that Joe gave away our years there, but you probably could tell by the gray in our beard that it's been a minute, and the majority of those minutes spent in this space. So yeah, I've been in the unemployment world since 2003, and as Joe said, was previously with another third-party administrator in this industry, and was fortunate enough to be able to move over here to HRlogics in 2022, and start building something special here. As mentioned, his experience, background, the majority of mine is on the opposite end, mostly in tax, as it relates to unemployment tax rates, also in merger and acquisition restructurings, and working with clients to try to make sure they take advantage of all the opportunities that are in the unemployment space as it relates to transfers of experience and continuation of wages and those types of things. So just really trying to be really collaborative with clients throughout those years, to making sure that they save as much money as possible and see the benefit of all the different aspects of our services.
That's him. Well, I promised no presentations, so I am going to stop sharing my screen and get into our first questions of the day. All right, you guys ready?
Ready.
I think so.
All right. Well then, so let's see here. We have seen sides on your website, and you brought it up on one of the past webinars. But what is sides, and why would it be important for me that you connect?
All right. Well, I'll field that one because that typically falls on the claims side of the house. SIDE stands for the State Information Data Exchange System. It is put on by the National Association of Workforce, State Workforce Association. I always forget what the acronym stands for, but it's NASWA. Their process, they came together and built ultimately a conduit of information from the state agencies to employers and third-party administrators such as HRlogics. And when someone files an unemployment claim, back when I started doing this, everything came to you through the mail. You would get, they would file a claim, someone would input that into a claim system at the state level, and it would come through the mail. Obviously, it would take some time. By the time you got the claim, you would have 4 or 5 days to turn around on a response because it's taken a while to get to you. And the states all had different timelines on when their responses were due. The collaboration and getting together and really kind of trying to streamline the process through sides gave an opportunity for states to communicate the request for information electronically through sides to TPAs. We could then pull the claims down and we could get them almost instantly. We can get them almost the same day the claimant files their claim. Goes into the state system. The information is uploaded to the side system. We then pull it down. We're able to give our clients much more lead time in coordinating on gathering the information we need to respond to a claim. Gives us a very uniform pattern for how we respond back to all the different state agencies. So it's really been a great tool. They started with the separation information exchange, which is when somebody files a claim, they need to get the details on why somebody separated. That was the starting point. They've added 4 different exchanges to that over the years. There's been the monetary and potential charges exchange. There's additional information. So if they need to do a follow-up, ask for more information, they can do that through sides. And again, it comes through electronically. We can respond electronically. They have the decisions and determinations exchange, where they can immediately electronically upload a determination to us. Again, gives us more lead time to our clients. And the last one, which some states are still working on getting connected to, is the benefit charge exchange. That one is the next piece of the puzzle we hope that we're going to see fall, but there's no states currently live on it. The important thing is we are live on all. We are ready to go. Well, there's one more. There's the earnings verification exchange. We're on that one as well. So wage audits typically have been sent by mail as well, but earnings verification gives us an opportunity to respond to wage verifications or wage audits related to unemployment through the sides exchange. So we're connected to all the different exchanges and can communicate that back to the states. And again, gives us an opportunity to give our clients as much lead time as possible. There's nothing more frustrating that we've heard in this industry than somebody getting a last minute request. I never want to be somebody's hottest fire.
Yeah, good information. Thank you, Joe. So we've got another one in here. And again, just a reminder, put all of your questions in Q&A, but we did receive quite a few prior to the start of the webinar. So I'm going to go through those first. But again, don't be shy and put your questions in the chat and we'll make sure to get to them in the Q&A section. So can you go back and provide past audits? If so, how far back?
Yeah, I think I'm assuming by audits we're referring to, you know, claim responses or audits of claims, maybe even benefit charges. Um, Generally speaking, the answer to that is no, simply because every claim and every process within the claim, whether it be the claim itself, determination, hearing, benefit charge statement, et cetera, they all have deadlines associated with those documents. So generally speaking, a benefit charge statement is going to have a 30-day deadline. If you miss that deadline, I mean, you can try to go back and file an appeal, a late appeal, and perhaps it will be approved. But in general, everything with a deadline driven to it, you don't want to go back. Now, there are exceptions to that from a tax perspective. There is a historical look back period from a tax end of 3 years. And again, that doesn't necessarily meet it. The standard is 3 years. Some states are five, some states are two, but the standard is three. And that doesn't mean that you can go back and protest your tax rates or anything associated with that, 3 years later. What that means is that if you have some type of tax issue that spans over a 3 year period and the statute of limitations is still open, then you do have the capability of going back and securing that tax credit or savings opportunity if you know what it is and how to do it. Then you have capabilities there. But from a claim perspective, that's generally not a thing.
Do you all help with that?
Absolutely. Um, yeah, tax. So what we refer to that in the industry is called tax recovery services. And yeah, I've done a lot of projects over the years in that space. And normally those issues fall around mergers and acquisitions. Um, they can also apply when those types of transactions happen. They can fall into continuation of wage opportunities, things like that, where companies can secure some credits. Maybe they started over on the wage base and they didn't need to. But again, it's all state by state. It's all statute driven. So, there's not going to be one universal answer. It takes someone who knows what they're doing and has some experience to go back and look at those individual situations and determine what the opportunities are.
I actually brought this one up in one of our calls earlier, Josh, but favorite question or favorite statement I love to hear. I have a 100% win rate on my claims. Why should I use you?
I mean, that's a great question. I have yet to obtain the 100% claim win status in my career, because every claim is unique and different, and every state is different as far as how their statutes go. And what is generally a perfectly good reason to separate someone in one state is not a good reason to separate them in another. Having said that, you know, what we see a lot is companies whose HR team generally is responsible for processing those claims, and they probably do a great job, right? They don't miss deadlines, they get their information in, but that's really only the first step of the process, right? I mean, you can win 100% of your claims, and yet your tax rates can still increase. And people will ask, well, why is that? Well, it's because there's a step in the middle there that you're not taking advantage of, and that's the benefit charge auditing piece of things. So, and we can share this link at some point with folks as well, but on one of the Department of Labor websites, they will give you a map of all the overpayment rates, erroneous charge rates is what they refer to them as, by state. And right now, I believe Florida's at around 36% error rate. So what does that really mean? Well, it means when they issue a charge statement to an employer for $100, $36 of those are a mistake. And so if you're not auditing those charge statements and comparing the individuals that receive benefits against the status of those claims that you work so hard to fight, then chances are you're missing opportunities to decrease those benefit charges, which directly impact your tax rates. So that step in the middle often gets missed, especially when companies are doing it in-house. The HR team does a great job handling those claims. The finance team or payroll team usually does a great job collecting those tax rates and making sure that they get paid correctly. But the connection between those two are those charges. And if you're not monitoring that, then you could be losing money.
I went ahead and dropped that link into
Oh
the
yeah,
chat for
great.
everyone as well. So if you are online and want to see where your state lands, feel free to click on that. I was just looking through it yesterday and saw, yes, Florida, a very high
I
percentage,
think
but
I think Florida and Rhode Island are the two highest right now. Tennessee was
yeah,
up there, but I think we've maybe gotten our stuff together a little bit in our state. So
yeah, Virginia
yeah,
too. We're
yeah.
neighbors. So
So
yeah, like Rhode Island was 45, and I think Virginia and Tennessee have now gone just below 30%.
I mean, it's still not great, but you never want to be the worst. So that's what we're shooting for.
That's true. That's true. I think any overpayment is probably not
Right,
great because
right.
that means you're overpaying where you shouldn't be. So
Exactly.
All right, let's
Exactly.
go down. Joe, I want to give you a chance to speak here too. So I'm going to step aside from the tax side of things real quick and give a couple of scenarios that we got in. Um, so let's see. I moved from Florida to Georgia last year. In the past, I was used to our company's liability being tied to their historical wages. But on my Georgia claim, I had a claim where the liability looked very high for a less than, and I got cut off here, less than 6 month employee. Why the difference?
All right. Well, while unemployment was created from a federal mandate, ultimately the different states have been able to create and manage their own systems, and they all have some uniqueness to them. And one of the uniquenesses between Florida and Georgia, the cases we're talking about, Florida is one of the is uses a system that is most common, which is the proportional charging system. When somebody files a claim, the last employer, the person's separation from that employer determines the person's eligibility for benefits. But they go back and they look at the base period, the first four of the last five completed calendar quarters, and every employer that paid wages during that base period shares a percentage of the potential liability. So if you paid 10% of the person's total base period wages, you've got 10% of the potential liability on their claim. So if they are getting $200 a week in unemployment, you could potentially be charged $20 each week. Georgia is one of the states that only the last employer carries all of the potential liability on a case. So their measurement is the last employer that paid the person 10 times their weekly benefit amount. If you meet that threshold, all of the liability on that unemployment claim belongs to you. So anything that they draw is going to be charged against your account. So in those last employer states, while they may not have worked for you as long as you're used to in Florida, your liability can be much higher because all of that liability from all of their base period wages comes to you.
Interesting.
And there's 53 different agencies doing it. Not always 53 different ways, but they all have something unique about
Pays to be an expert in the space to know what's going on.
them.
If you guys have any more questions, please make sure to put them in the chat. And if you have a follow-up question to anything that Josh or Joe are saying, please put that in the Q&A as well. So we want this to be more conversational and relevant to what you want to hear. So with that, I'll go through and ask one of the other questions that we got. This one's pretty simple, but are all of your employees US based?
I mean, it's simple, but in our industry, it's not the norm anymore, unfortunately. But yes, all of our HRlogics employees are US based. Um, our our physical office is in Nashville, Tennessee. That's where Joe and I and a few other members of our team are all loosely based around Nashville. We have a pretty large team based out of Michigan as well. And then, of course, we've got remote employees in Philadelphia and North or Pennsylvania, North Carolina, Virginia, all spread around for various reasons. But one thing that I will say about that is from COVID came, a lot of remote work, which we all know. But from our perspective, I think what that brought was the ability to go out and get the best talent, right? Before COVID, at least at my previous place of employment, you never even dreamed about hiring remote people. It wasn't a thing. They needed to be in the office that was also in Nashville, and you needed to be there. And so I think, that way of thinking post-COVID has allowed us here to go out and get the best talent, not necessarily whoever is local and available, right? So, and I think that's been a great advantage for us as we've continued to grow this company to have really great people on our team. Um, and not only people like Joe and I that have a lot of years and a lot of gray hairs to show for it, but a lot of young people on our team that, have really bought into what we do and have really grown. I mean, an enormous amount. And Joe, you can speak about this with a lot of your claims team. I mean, those guys and gals have just, I mean, from the day we got here to now, it's like night and day, and it's great to see. I mean, that's part of why I love being, in management is being able to grow talent, being able to, I'm almost like my background, all through school was in sports, right? So I love being part of a team, love being a team leader, love seeing other people do well. And so I think, that's the what we try to do here.
Oh, when you mention gray hairs, it's always nice to be building a team where you can look and say, when I do decide to hang it up, it's going to be
Yeah,
in great hands.
exactly. Exactly. And I think, again, like I think Joe, as you and I were talking before this call with Elizabeth, some of our mentors, they invested a lot of time in us, and I'm forever grateful for that time investment for sure. But part of what you and I have talked about over the last few years is, it's now our turn, right, to try to pass that down. So yeah, it's been fun. Been fun doing that and growing this team has been great. And yeah, having everybody US based obviously makes things translate a lot better. Everything unemployment is US based as is, right? We don't Canada doesn't deal in unemployment as far as experience rates and things like that go. So, just makes sense that everybody's in one continent or one country, one space, so that we're all speaking the same language, so to speak.
There you go. And I'm going to mention it even though I'm not supposed to because we're a day early. But with that team that you guys have brought up, 8 years running, Sides Award.
Oh, yeah, I mean they're all there right now. I think it's fair to say it. Yeah, so yeah, Holly Poulos and Amber Saloka from our team are at the National Sides Conference right now, accepting our award probably today for our eighth straight year of outstanding. Is it outstanding
Outstanding
performance? Is that?
performance. Yep.
Yeah, yeah. Um, so yeah, pretty proud about that. That we've been able to continue that level of excellence for 8 years straight, and no reason to stop here, I don't think. But yeah, as we've grown, I mean, that's obviously been challenging to grow as a company, but also maintain that type of standard. And so, I think, as I said, in the internal announcement that, I sent out a few weeks ago, I think it's just a statement to say that, companies can grow and do good work at the same time. It's not a either or. So, and that's pretty much what we adhere to here.
Well, it's a testament to you guys, your work ethic, and what
I mean,
you've passed along internally.
honestly, it's all Joe. I just I accept the award, but his team is the one that coordinates with sides, so it's a 100% on him and that team. And again, it's just been
Uh,
we've been very blessed to have a good team around us in all areas to keep this up.
yep. They have all bought into the service model and they make sure that it gets done
Yep,
right all the time.
yep.
Yeah, well, let's bring up another scenario that we got. So, I responded to a claim recently and I was stunned that the state found the person eligible for unemployment. The employee violated our attendance policy, and I sent them a copy of our attendance policy, the employee's attendance calendar, and warnings. How could they rule this way?
Mm.
The bane of all employers in the unemployment world.
Mm,
Attendance is the most frustrating type of separation when it comes to an unemployment claim that employers will encounter. You can follow your policy 100%, give everybody the warnings that are required. You are going to enforce it 100% of the time the same way. Everybody knows what the policy is, but most states are going to take a look at what was the final incident, what was the triggering event that caused the claimant's discharge, and say, was that an act of misconduct under the unemployment law? And misconduct has been defined as a willful or deliberate disregard for the employer's best interest. So when you get into a situation of attendance, most states are going to take the stance of, did they call in and report their absence? They did. What reason did they give you? They called out because they were sick, or they were called out because they had to care for a sick child. They couldn't come to work. The state's going to say, you did everything that you needed to. You had just cause for letting this person go. But that act, the final incident, was beyond their control. They couldn't help that they were going to be absent that day. It's not misconduct. And most states, then the follow-up question is usually, but they didn't give me a doctor's note. Most states don't require that. It's not going to be something where they have to prove that they were sick. If they called and reported their absence as required and reported it was for a reason that's beyond their control, you they're probably going to be eligible for unemployment benefits. Second follow-up question to that is usually, well, should I have held on and waited until there was something that, there were no call, no show, or they were tardy? You always want to follow your policy, whatever your policy says, because there are states, if you wait and you separate them on, you've got a 10-point policy, you separate them on a 12 point because you wanted to get something that was within their control. Some states will say, well, you let this person go at 12 points, you let this person go at 10 points. You're not uniformly enforcing it. People really don't know when their job is truly in jeopardy, and that can cost you multiple claims. So you just want to make sure that you're doing what's in the best interest of your business, making sure you're letting them go and being uniform in the way that you manage your policy, because that's important for everything and unemployment.
Good to know. I never even thought of that. Let's keep it with you, Joe. So I received a claim from the state for someone who separated over a year ago, and I know went to work somewhere else. How is their claim against us?
All right. Well, tying back to the Florida case that we talked about earlier, most states use the base period to determine potential liability on a claim. So the separating employer determines whether or not the person is eligible. But every employer that paid those base period wages and has that potential liability also gets a claim, and in most states has an opportunity to protest their potential liability on that case. So that's why you're getting it. It's not that they're filing a claim so much against your company as you are an interested party. You are a base period employer. Whether or not you send it back, the person quit to accept other work, they went to work for the most recent separating employer, your account's not going to be charged. But in most states, that doesn't impact the claimant. Their eligibility and how much they draw doesn't change. That's all based on their last employer. Your account is just not charged, and it doesn't impact your tax rate. So that's why you'll typically see a claim that goes back to somebody that separated a long time ago. And that, like right now, this is the best time to talk about the base period. We're in the second quarter.
Mhm.
Second quarter, you go back, first four of the last five completed calendar quarters. If somebody files a claim today, the base period is the calendar year 2025.
Alrighty. So I've heard you say you can stabilize our SUTA rate. What does that mean and how does it work?
Well, it as we kind of discussed through here, so the way that can work is, again, just responding to every unemployment claim. I mean, that's always challenge one, right? Getting every claim, receiving every claim that's filed against your organization, and then responding to it timely. And I know that sounds simple, but that's objective number one. Uh, Obviously, as part of that, you want to supply, as Joe's talked about already, sufficient information, full details of separation, final incident, all those things, so that the state agencies can make their rulings appropriately. And, again, in that, some folks are going to be found eligible for unemployment because based on state statute, they are eligible. And that is all there is to it. But again, by doing all of these things that you're doing, and responding to those claims timely and winning the claims that you should and can win, then just by doing that simple task, and it sounds simple if you got 10,000 claims, it ain't as simple, but if you're doing all of that properly, then you're minimizing the amount of benefit charges that are impacting your unemployment account. And again, as we talked about before, that's the number that's going into that rate calculation. So now there are always going to be uncontrollable factors as it relates to these state tax rates. And every year, states are adjusting tax rate tables based on the level of their state trust funds and things like that. Most of those are all statutory driven. So there's nothing that you as an employer can do with it. So, when we talk about tax liabilities and things like that, especially from an unemployment perspective, I really think of unemployment tax as being twofold, right? There's a controllable aspect of it, which is the claims and all the things we're talking about today. Then there's that uncontrollable aspect, which are, changing of rate tables by statute, increase in taxable wage base, which, if you're on the West Coast, in Oregon or Washington, bless you, with the $60,000 plus taxable wage base per employee. That's the highest in the country right now, and insane. Knowing that California just below is only 7,000. Just think about that for a second. Um, while California has like $1 billion in debt in their unemployment trust fund, but that's a separate conversation. Um, so, all those things as an employer, you can't control, right? It's just, I mean, it's no different than your personal tax, right? Like You pay the taxes you're supposed to pay. You can't control what Congress does, those types of things. So yeah, just, that's the way you mitigate these tax rates and do your best that you can to control them. You'll never win, if you will, from a tax perspective, right? You know that personally, and business is no different. But you can do your best to control that number, so that, your internal expenses and business operations don't have to see increases on a year-over-year basis, which, ultimately impact your OpEx and everything else as a business. You can't innovate and do new things if you've got all this expenditure on here on payroll taxes and it's going up and up every year. So you want to be able to do the things you want to do to move your business forward, and this is one way to control that.
The only controllable tax.
That's right.
So, do each of your clients have a dedicated team assigned to them?
Yes, they do. And this is an important piece in our industry because there's been times where we've heard movement of people going to treating this kind of like a call center. Claim comes in, it goes to the next person up. The reason that having a dedicated team is important is they become familiar with the client themselves. So there's a good flow of communication between our client and our analyst. There becomes a familiarity with policies and the different procedures that the client has so that we can best write a claim response on behalf of that client. So we keep a dedicated team assigned to them, and we also do our very best as we grow to keep that static. We try not to make a lot of movements from one analyst to another, so that they do have that good communication and their familiarity with policies.
And I think, Joe, it's important to know too. I mean, and again, it's been a long time since I've been a claims analyst. I'll admit that. But when I was, I mean, as a claims analyst, I mean, you develop personal relationships with these contacts. I mean, you're talking to them very frequently. I mean, I can remember some of the contacts and I won't name any of the clients on this call because I don't want that recorded for other purposes. But I mean, I can remember, being invited to people's like showers, baby showers, and,
Yep.
getting, birth announcements from contacts that I had never met in person, right? But you talk to them 3 or 4 times a week. I mean, it becomes first name basis type stuff. And that's, again, that's just part of that service model that, Joe and I were instilled in us as we were learning and coming up in this industry, and frankly something that's kind of getting lost, to be honest, in this industry, and what Joe and I want to continue to carry forward here, is that first name basis style of service.
Not just a number. I like it.
That's right.
So, given that unemployment claims contain PII information, what security certifications or protocols do you have in place to ensure this information is protected?
Man, we got a lot of acronyms here. The most important one and the one that everybody in this industry is going to look for is SOC 2 Type 2. That is industry standard. If you don't have that security certification around not only your platforms, but your operational controls as well, it is a twofold certification. Um, if you don't have that, you're not really a player, so to speak, in this industry from a TPA perspective, right? But there's a lot of other security certifications out there that operate behind the scenes and go along with that. Some of them I'll just name off really quickly, like the PCI DSS. That's a big one. That was before SOC 2 Type 2 became a thing. That was the most important one to have back then. Obviously, there's the California Consumer Privacy Act, and we're in compliance with that. There's a whole page on our website that lists all the different acronyms and certifications as to what they are. One of the newer ones I will say, that we've implemented is the NIST platform, and that's just an enforced layered of security and encryption within our platforms and all of our AWS servers, just again to add that additional layer of data security, so that, forbid there ever is some type of breach, then there's multiple layers of security that those folks would have to try to get through in order to get our data. And to be fair, not everybody in our industry has that level of security, because quite frankly, it is expensive, but it is important because of the type of data that we're handling. The other thing that's kind of, I don't want to say it's new on the horizon, but it's kind of new over here on this side of the pond is GDPR. right? Everybody's moving to that. So we've already adopted those requirements within our own services and operations and things like that. Just with the understanding that sooner rather than later, that will be something that will be implemented stateside here, and we'll all be adhering to it as well. So we're already following those guidelines as well. So trying to stay ahead of the curve on that.
Fort Knox of data.
Yeah, takes a village to manage that for sure.
Yeah, well, with all the data breaches you constantly hear about, I'm happy to hear that we are making sure that it's protected in any and all ways.
Yep.
We've got another one here. So I used to work for a company that doesn't protest claims that have under $1,000 in potential liability, but my new company protests every claim regardless. Which of these approaches would you recommend?
All right. That is something that I have run into in the past where I've had clients that have assigned a monetary value where it's not worth our time to pursue a case if the potential liability is below X. I get that. And if you've got a huge payroll, yes, a small liability unemployment claim may not have an impact on your tax rate. However, and Josh will certainly back this up, you never know which dollar is the one that's going to push you to the next tax rate. So
Yep.
while the liability may be small right now, it, if it goes, you get charged $50 on that claim. That could be the one that moves you from this tax rate to the next higher tax rate. And depending on what your payroll is, it could be a huge number that ends up on your bottom line. So typically, I'm going to be on the side of we want to protest every claim because there's also a second part of it. We talked about cases where you're a base period employer. Well, you may not have a liability on a claim today. Person worked for you for the last 6 months, or they started in January. They're not in the base period. Started in January, separated last week. There's no base period wages on that claim this year. You don't have any potential skin in the game as far as your tax rate. But next year, they go to work for another employer and they separate, and now they file a claim against a more recent employer. Now your wages are in the base period. Most states will not look at that separation twice. Since you didn't pursue the case now and they were eligible for benefits, that same separation next year you're chargeable on, and it is going to impact your tax rate. So we're always going to be on the side of be aggressive. Again, and Josh, you can definitely mention that. You've
Mhm.
probably got some stories of how close it got.
Yeah. No, I mean I've seen instances where literally like $1 is takes a client from a tax rate of 1% to a 1.5, right? So now again, nothing to say that I tracked that $1 back when that happened to a specific claim, but I mean it is that close, right? I mean most of these tax rates are calculated using ratios, and those ratios go out to the hundredth, if not the thousandth. So I mean again, just think about that. Like $1 can be the difference. And so yeah, from our perspective, um, our general advice to every client is don't even worry about the value of the claim. Let's just respond correctly, accurately, fully, timely, all the things, and then let the dust settle, right? And then we'll worry about it later, so to speak. But yeah, as Joe said, I mean, we've definitely seen clients, assign that value to it. And listen, that's the beauty of being a service provider is, we take our direction from the client, and if that's what they want to do, we're more than happy to facilitate and manage it that way. But that would not be our preference.
Hmm. I've got a couple of questions that are somewhat similar, but I'm going to ask you both of them here. So we are currently finalizing the purchase of another company. Is there anything we should consider related to unemployment?
Oh, I love it when somebody asks before than after. The short answer to that is yeah, there's a lot. Um, so like we talked about earlier, with unemployment tax rates that are assigned by experience, which means they can fluctuate based on payroll, based on benefit charges, based on all kinds of tax payments and reserve accounts. Anytime you're acquiring, there's merger acquisition activity, right? there are provisions in state laws that say that you, as the successor employer, can inherit the tax rate history of the predecessor if you choose to. Sometimes it's mandatory, sometimes it's optional. Optional is what we want because then you have a decision to make. If it's mandatory, then you're just stuck regardless, right? But based on that state statute, you do want to do some investigations. You want to get from that company that you're purchasing, what is your current tax rate? Give us a copy of your current rate notice, right? How many people are we acquiring in each state that you're in? Because that's going to make a big effect on even if nothing happens with your tax rate, you're adding head count, which is then wages, which are then tax payments, right? So, which I'm sure your finance team has probably already done that and estimated what our additional tax liability is going to be by adding these heads. But what they don't look at typically is, okay, what time of year are we adding these heads? Is it January 1? Is it mid-year? Like what time frame are we looking at? And then what's our opportunity there from an unemployment perspective? Can we acquire the history of the predecessor as part of the transaction? If so, does that decrease our unemployment tax rate? And if so, when does that happen? Does it happen on the date of the acquisition? Does it happen at the beginning of the year or the following year in which the acquisition occurred? So on and so on. So there's just so many things that can actually be looked at and analyzed during that process. And to be fair, unemployment is usually like number 90 on the list of things during due diligence. There's so, you got benefits to transfer, you got all these things that happen. And I totally understand that. I'm never going to be first on the list. But for most of my clients in the past, I've just said, hey, here's a one-page due diligence document for unemployment. Just some simple questions. Just slip that in the due diligence package. When it's all getting filled out, somebody will fill that sheet out too, and then send me that sheet. And that gives me an idea of what we can do, what we can look at, what opportunities you might have. Maybe you have nothing, right? But at least you feel good about knowing that someone's looking at it and can present that to you if you do. Because, again, I've seen situations where companies have gone through large acquisitions. They've been able to obtain tax rate decreases by transferring the experience of the predecessor into the successor entities, which then ultimately saves them money in that year. And then the transaction happens mid-year. They've started over calculating taxable wages for those employees when in fact they could have not done so. So then you go back and recalculate those money to get millions of dollars in refunds, literally. Um, so yeah, there's just so much opportunity there that people don't know about. And again, I think that's why it's great to have TPAs like us and others in the industry to help employers go through those situations and help them maximize their opportunities there.
True partner.
Yeah.
So if we are involved in a merger and acquisition, are we required to report anything?
All right.
So in that scenario, are there
Yeah.
any tax saving strategies we can take advantage
Yeah.
of?
Yeah. So I mean, we kind of just touched on the tax saving strategies, but yes. So there was a law passed 2005, the SUTA Dumping Prevention Act of 2005, I think it was. That really dates me. But yes, that act that was passed at the federal level essentially at that point requires every employer, anytime there is a merger, acquisition, restructuring, or reorganization, that and as a result, employees are moving from one federal identification number to another. That's probably a key comma there, then that transaction must be reported to the state unemployment agency. And the reason that is because prior to 2005, what companies were doing, which by the way was totally legal. It's not I mean, it's a great business strategy, honestly, assuming it's legal. What companies were doing is saying, okay, we have three legal entities here. Well, this legal entity over here has got a really high tax rate, and most of our employees are paid out of that. So we're paying a ton of taxes, right? But this new entity that we got over here's got a lower tax rate. So why don't we just move everybody over here, save some money, right? Sounds smart to me. But from a federal perspective, they're looking at that going, wait a second, you're moving all this payroll and now we're not getting our tax money. And as we all know, our government loves their tax money. So people were doing that. And again, that wasn't against the rules at the time. It was just a business strategy that was being employed. And so, of course, in true fashion, the federal department or U.S. Department of Labor put signed this act in 2005 that said, okay, if you're going to do that, that's fine. You can still do that. But when you do it, you have to report it, number one. And when you report it, we're going to take that tax history and move it with those employees so that there's a net zero gain. Now, again, there's been a lot of tweaks to that since 2005. That's been a minute. But the essence is that yes, you want to make sure that you're in compliance to report those types of transactions. There can be pretty large penalties and fines if you don't do that and states come back, especially if that would have resulted in you paying higher taxes and therefore you kind of skated on it. In the SUTA Dumping Prevention Act of 2005, it imposes up to $1 million penalty for non-reporting, specifically in cases of SUTA dumping. Now, I've only been a part of two or three SUTA dumping cases in my career because fortunately, the places I've been have advised our clients correctly. Um, but in the few that I have been involved in, we've been able to get. I've never paid a fine. None of my clients have ever paid a fine. So we've been able to beat the case or whatnot, get them waived, whatever. But you don't want to be in that situation. So don't put yourself in that spot. Just report it. It's not that tough. There's simple forms that are pretty easy to fill out and send in. Most of them these days are online, obviously. Um, and then, like I said, then you can start looking at the opportunities that we talked about earlier and seeing how you can maximize the benefits from it.
If I let someone go during a 90-day probationary period because they are just not a good fit, are they able to draw unemployment benefits?
All right. Finally, a claims question again. Took us a minute. I've listened to so much tax talk, I'm almost asleep. Yeah. 90-day probationary period. Good threshold for employers to have. Make sure that they've got a good match. But you got somebody that's just not cut out. They're a good person. They've tried their very best. Just a bad match for the job. You let them go. Come back to that definition of misconduct that I mentioned before. A willful or wanton disregard for the employer's best interest. That's the measurement that the state's taking a look at. They're going to be eligible for unemployment benefits. They made a good faith effort. They did everything they could. It's not an act of willful misconduct on their part. The There are a handful of states, I say handful, a few states that if you're just a base period employer, you know, person filed against a more recent employer, that's going to determine their eligibility for benefits. If you let them go as a base period employer during a 90-day probationary period, you can be relieved of charges in that case. Florida, uh, we see it in Oklahoma. North Carolina is a 100-day probationary period acknowledgement in their unemployment law. So there are some opportunities to be relieved of charges. It doesn't impact that claimant's eligibility for benefits. One of the things that I always come back to is I see employers so many times get penalized for being nice people. You hire somebody, you've got that 90-day probationary period, and you really like the person. They're so good, and you want to do right by them. They're just a bad fit. So instead of pulling the trigger when you know it's time, it's gonna end that way. You go, you know what? I'm going to put you on a PIP, and I'm going to give you 60 days to improve. And 60 days come and go. Person's still trying their very best, still a terrible fit for the job, and you give them another PIP. And I've seen employers continue that and continue that and continue that, and finally, a year and a half from now, they finally come to the conclusion this is just never going to work out, and they let the person go. Same thing they would have done at 90 days. But now you've employed and paid them wages for 18 months. Now, instead of that 90 days typically is not going to be in the base period, you wouldn't have any liability on that claim. Now you've got full base period full of wages and potential liability on that claim, with it still being an issue of its inability. The person just couldn't do the job.
So we'll keep it with you, Joe, since you were falling
Oh,
asleep. We don't want to
yeah,
have
thank
that
you.
happen. So I do have another one for tax rate if you want to take a breather for a second, but
No, no, no. Let's stay with me. I like talking about claims.
all right. Fair enough. So I discharged someone who reported to work clearly under the influence. We have a zero tolerance policy. I got a determination back from the state that they were eligible for benefits. Why would that be?
All right. Always remember that the unemployment agency is not just going to take your side of the story. They're always going to ask the employee for why did the employer let you go? You're going to give them your information. They're going to say they were clearly under the influence. They're going to ask that employee, did you go to work under the influence? I did not. What proof do you have? You can report all the visuals. You can report everything that you can. There's going to be some state agencies or some individual adjudicators that will say, sure, you've given me enough to find this person disqualified. But letter of the law and the specifics, you have to prove their act of willful misconduct. You have to prove that they were under the influence. So if you've got a policy, typically employers have got that policy about drug and alcohol, and it usually is going to reference an opportunity to send them for a test. If you're going to let somebody go for that and you have an opportunity to send them for a test and or them refuse going for a test, which is also a violation of your policy, now you've got something concrete. We've got a test result back that shows they were under the influence. We've got, confirmation we told them we wanted them to go for a test and they refused it, which is against policy. Ultimately the same as a positive test in our mind. Now you've got something concrete. You've got something documented. If you go to a hearing, let's say you win the case originally, you get the adjudicator who's heard everybody's story. There's always going to be a personal or a people part of this process. I say there's always going to be. They're going to try and get AI into this somehow, but they're that person's heard all the stories, they've heard all the excuses, and they're going to find that person disqualified. They appeal it, it goes to a hearing. Now it's firsthand testimony. The claimant gets into the hearing under oath and says, I was not under the influence. All you can say is they looked under the influence to me. That's all you can prove with your testimony. It's typically going to go their way. So you want to get documented proof if you can. And I'm always going to go, you want your policy, their acknowledgement for receiving that drug and alcohol policy. If you've got test results, and typically if you can get a chain of custody form, something that supports
I
this
was gonna
is
ask, yeah.
this is the sample from this person that was tested and came back positive. If you've got those four things, you've got a pretty ironclad case from an unemployment perspective.
I was gonna ask you about the chain of custody because that comes up sometimes. So,
Sometimes that's the one that's a challenge to get, but if you can get it,
mhm.
it's a great piece of evidence.
All right. Well, if we receive an unemployment tax rate notice, we simply forward it to finance. Is there anything that we should be doing with it?
Yeah, there's a few things. So, well, again, it all depends on who receives it, right? But yeah, I mean, your finance team, payroll team, whoever handles your tax filing is certainly going to need that rate. Maybe a third party outside that will need that. So you want to make sure they definitely get that so that they can update their records and, be paying at the correct tax rate. But there are other things, as we talked about already, just, reviewing those benefit charges, making sure that the benefit charges match the charges used in that calculation so that you can somewhat confirm the calculation is accurate and legitimate. Obviously, you want to do that if you can or you have the ability to do that. But then you also want to look at some other opportunities. Now, in 25 or 6 states right now, it changes periodically based on California and Kentucky. They offer opportunities to lower your tax rate. You can make a one-time payment and decrease that tax rate for the upcoming or current calendar year. Um, if you don't know how to do that or how to calculate that analysis, you'll want to reach out to somebody that can help you with that. But, um, again, it's kind of like we talked about earlier about the $1 changing it from, one rate to another. Voluntary contributions can be very similar. Most of the time, a VC is not going to be advantageous, and that's just a general rule. But there are times where, as we talked about earlier, you're just right on the cusp, right, of this next lowest tax rate, and so a $5 payment will lower your tax rate 0.5% and save you $100,000 next year, right? And that happens all the time. So, it's worth looking at. It's worth taking a peek at. Also, if you have multiple entities operating in certain states like Ohio, Arizona, West Virginia, Missouri, New York, New Jersey, they have what they call joint account or common rate groups. And so what that is essentially taking all of your legal entities for tax purposes only, not legally or anything like that, but combining the experience of all of their tax rates and computing one rate that all of your entities will then pay at. So what we typically see in those types of scenarios is you've got one account that's at the minimum tax rate, and then you've got others that are kind of scattered. But if you combine them all, then they all get down to the minimum, right? And that's great. That's what you want. So, again, analysis is required there to figure out, what that corresponding or outgoing rate will be to make it worth your while. But at that point, you'll want to look at each state's requirements. Not every state has the same rules and requirements as it relates to these. So you'll want to make sure that you look over those real closely before you make any application to that. And again, that's where a TPA like us can really help you navigate those waters.
I feel like I need a hook right now with music to kind of pull you off the stage. Joe was right. I don't know that I should have ended on a tax question.
Lot of tax stuff.
No, it's a ton of good information. So I mentioned at the top of the call that today is the second of our new Ask Me Anything webinar series that will be occurring monthly every third Thursday at 3 p.m. However, we will also be hosting one-off webinars, and our next one will be again with Josh Kendall next week on the 21st at 2 p.m. So in this educational webinar, HRlogics and a core will explore how unemployment claims management works specifically within the staffing industry and why many agencies don't realize they're exposed until the tax rate notices arrive. So scan the QR code on the screen to register today. On our next AMA series will be on May 21st at 3 p.m. We'll bring Melissa Prentice, president of HRlogics I-9, so forming compliance complexities and audit readiness to onboarding workflows, remote verification, and evolving regulatory requirements. No topic is off limits. You won't want to miss it. So scan the QR code to register. With that, our webinar will conclude. If you don't mind, again, I love some QR codes, but please scan this QR code to complete a brief survey. By doing that, we can ensure we're bringing topics that are important to you to the forefront. Thank you for joining us today. Thank you, Josh. Thank you, Joe. And have a great day, everyone.